Welcome to Markets Now. I'm Michelle Rook along with Ted Seifried with Zaner Ag Hedge. And we're trading lower here as we move through the mid-session with the exception of old crop corn. And really, Ted, we've seen a lot of risk-off selling again here today ahead of the Fed announcement, right?
Yeah, it's kind of they're really targeting where they're risk off and where they're not. Because if you look at crude oil, it's actually been higher for a good portion
Right.
of the day. But especially in the grains, there's been a lot of risk off, and especially in the soybean complex. I think a lot of that actually has to do with the weakness that we've been seeing over in the Chinese futures on the Dalian exchange. They continue to push into new recent lows, which really begs the question, what's going on in China? And also really begs the question of our recent export sales in soybeans. Does some of that get canceled if the Chinese futures are still under pressure and the crush margins continue to be under pressure? So that's really kind of causing a lot of question marks for soybeans, and soybeans have broken some very key support here today, breaking below that 200-day moving average.
Absolutely. So what do you think is going on in China? Is it ASF or it's got to be a demand slowdown of some sort, doesn't it?
Right. Yeah. And so judging by crush margins being under pressure, that would say that for whatever reason, feed demand has softened here pretty dramatically in the last few weeks. So if we read between the lines, I don't know if it's ASF. That would be probably the most likely culprit. We certainly haven't heard anything about that coming out of China. But then again, do we really hear things coming out of China until well after the fact? I don't know. But there's definitely some suspicion there, and I think it's very warranted. The best thing you can ever do with China is watch the numbers, watch their crush margins, watch what their exchanges are doing, what the futures markets are doing. That can maybe give us more insight into what their actual press statements are, because again, they're not very forthcoming with the information, but the numbers are the numbers, right? So there has to be something happening there. And maybe it's just simply that they've flooded their pork market, and that there isn't this big need to be really feeding animals to excess weights and things like that. I mean, it could be less benign things than ASF, but certainly feels like something's happening there right now, Michelle.
Yeah, it's always a guessing game with China, that's for sure. So as we point out, corn holding up better. Not only are we seeing the old crop corn maybe influenced by China purchases, but also the funds are not as long in that market at all. They've exited a lot of that length. So is that helping to take pressure off too?
Well, to your point, Michelle, when we're talking about risk off days, well, if the funds aren't terribly long in corn, there's not a whole lot of risk to take off for them. So that's good on days like this, where we are talking risk off in front of a big Fed announcement that really nobody knows which way it's going to go. I mean, there's a lot of people with opinions on this one. So that benefits corn. But I think really, we've been seeing these sales pretty much on a daily basis. The big cry in corn for the last few months has been, our export sales are so far behind. But all of a sudden, we're starting to see that happen. And now we're questioning, okay, can we catch up to the USDA's number? Personally, I don't know if we can. But there is a little bit more optimism in corn. There's continued planting delays in Paraná, which, that could put their second season corn crop at risk. So there are some things that have kind of changed for corn fundamentally that have become a little bit more bullish over the past couple of weeks. You also think that, some people would say that corn can't drop 20 cents right here because we're seeing the export business here. And if we were to drop 20 cents, maybe that export business would really accelerate. Personally, I would like to see what happens if corn drops 20 cents. Maybe we start coming with these bigger numbers again, like we were seeing at the end of last week. Maybe. I think corn can afford to go and tempt that export demand. But some people would argue that maybe we can't because of the big sales that we've seen recently.
So even though the funds are very short in the wheat market, we see Chicago scoring new lows again here for today. We're holding up just a little bit better in HRW wheat, but how much lower do you think we're going to go there in those markets?
Yeah, Michelle, that's a great question. I think fundamentally, I'm not so sure we're justified to be down at these prices in wheat.
No.
And, the funds, they keep selling. What's interesting is, we talk about a risk-off day. And, in corn, we say, well, the funds don't have much of a position in either direction. So there's really no risk-off for them in corn. In soybeans and the soybean complex, they're still long. So risk-off for them would be getting out of long positions. But risk-off in wheat would be getting out of short positions.
Right.
And they're not really doing that. So they have they've had tenacity to be short wheat right now. And I don't know what the trigger would be to really scare them out or flush them out of that position. But, if it's not happening on a day like today in front of a big Fed announcement, I don't know if it does happen. And maybe this is part of a bigger, broader bottoming formation in the wheat. I think that remains to be seen. We are flirting with new contract lows in the wheat. This could be the start of another leg lower. I think you have to approach the wheat market with a whole lot of caution from the long side of things.
What about cattle and hogs? We've had a sell-off, risk aversion there as well. Banking crisis was part of it. And now, the macroeconomics, the Fed announcement. So we've got to get the risk aversion out of the market before we can bottom those markets, right?
Yeah, that's a big part of it because, when we talk about risk aversion, that's also in the same sentence, you're pretty much saying demand concerns, right? If we're worried about the overall market, if we're worried about, people's 401ks and things like that, well, then we're also worried about how much people are going to spend at the butcher's counter, right? And that's something that affects beef a little bit more than it does pork. In fact, sometimes pork's the sort of recession substitute that funds get interested in. But yeah, we need to see some stability. We want to have a good feeling about where the economy's going before we can really get terribly excited about what things are in the future. That being said, we've got a very widely advertised supply shortage, right? I mean, we saw it on cattle on feed last Friday, but we didn't follow through to the upside. So
no, we faded it.
What's that?
We faded it.
We faded it, right? Yeah, and that's not good news when you've got a long-term or sort of a mature bull market that's now fading good news. So that was a red flag. The fact that we've had, we tried to bounce off a key support yesterday, following it up with the down day today is not what you really want to see. But fundamentally, I'm still bullish cattle as long as the economy is okay. We were due for a correction. Okay. This was that. Now, whether we can find some footing here and start to bounce back up, I think a lot of that's going to depend on what happens with the Fed decision, how the market reacts to that, and what our confidence is going into the summer and even fall months.
So let's talk about the Fed decision and the different scenarios. So quarter point, is that already worked into the market? What does it say if the Fed does that?
Yeah, so quarter point is the overall prevailing thought on what the Fed is going to do, right? We do have the banking issue. They've added a lot of liquidity to the market in their exchange desk. So they're creating inflation, or I guess recreating or slowing deflation, I suppose, by doing that. And then, they have to do something to offset it. I think that a quarter point is justified. I would be more interested in raising it a half a point to kind of offset some of the more inflationary things that they've done in the last 10 days. But also that puts a lot of pressure on the banks that they're trying to help out right now. So it's a very slippery slope that the Fed is trying to tread right now. I'm very curious myself as to what they're going to do. But it wouldn't be shocking if they were to pause. It wouldn't be shocking if they were to lower rates a quarter of a point. I can't remember the last time in recent history where there's been such a big question mark on which direction the Fed might go. And I also think that this decision might set the tone for the next few months, maybe even for the next 6 months or so.
Is it possible that they could just go a 0.5%, 50 basis points, and just rip the Band-Aid off and say, hey, we're not going to worry about that. We're just going to worry about inflation?
Personally, that's what I would be doing if I was Jerome Powell, if I was the Fed chair. I think a half a point is justified. You do have to provide liquidity to the banks, but there's a way to do that without having to lower interest rates. And if you're going to be doing that, if you're opening the discount window to them and giving them more funds, giving them more liquidity, well, that's creating inflation. And that means you have to accelerate your tools that you're using to fight inflation, which is your interest rate. Unfortunately, it's kind of an event where you have to support the banks. And again, this is the Fed's way of thinking, not necessarily mine, but you support the banks, but at the same time, you try to control consumer spending. So you put the pain really on the consumer rather than on the banks. And the way to do that is to continue to raise the interest rate, but also to continue to provide that liquidity to those banking institutions.
Okay. Well, is a quarter point already worked into the market?
Yeah, I mean, yep. The Fed funds market has got, 90% chance that it's a quarter point here today.
So if we got a 0.5%, man, this thing could get ugly in a hurry or not?
Yeah, 0.5% would be a pretty decent surprise. I think that would weigh fairly heavily on the stock market. It would be rather bullish for the dollar and probably rather bullish for commodities as a whole. Or I'm sorry, rather bearish for commodities as a whole. That would be a surprise. But, a pause would be it would do the opposite, right? I mean, it'd be bearish dollar, bullish commodities, bullish stock market. So again, there's a lot of things. There's a lot of possibilities for what we're going to be looking at when we get back to trading in the night session and tomorrow for the grains.
Yeah, it'll be interesting to watch this afternoon. All right, you're always the expert on that. Thanks for joining us, Ted Seifried with Zaner Hedge with Markets Now.